Welcome to The Explainer. Today, we are popping the top on a deep dive into one of the most famous companies on the planet, the Coca-Cola Company. We're going to break down its business, figure out what it's worth, and see if it's a smart investment right now.
So everything we're about to talk about really comes down to answering one single question. It's a big one. Can Coca-Cola stock actually give us a 9% return every year for the next 16 years? Having a specific target like this really helps us focus and figure out if this legendary stock is the right move for the long haul.
And to get that answer, we're going to follow the exact path an analyst would. First, we'll get a handle on Coke's business itself, then we'll run the numbers to see what it's worth. After that, a deep dive into the financials, we'll look at what the future might hold, and then, the best part, we'll figure out the exact price we need to buy at to hit our goal. Let's dive in.
All right, first things first, let's really understand what makes the Coca-Cola machine tick and why it's been so successful for so long.
You know, what's so genius about Coke's business model is how simple it is. See, Coca-Cola itself doesn't own all the expensive bottling factories or the huge fleets of delivery trucks. Nope, they let other companies, their bottling partners, handle all that heavy, expensive stuff. Coke just focuses on the most profitable part, creating the brand and selling the secret syrup. It's what they call a capital-light model, and it's the reason they can just sit back and generate these massive, stable cash flows. It makes the business a real fortress even when the economy gets shaky.
And that amazing business model? Well, it's protected by what investors call a moat, a massive competitive advantage. It's built on that world-famous brand, a distribution network that's literally everywhere, and, let's be honest, a powerful psychological lock-in from decades of us just making it a habit.
Okay, so we've established it's a fantastic business. But what does that mean in dollars and cents? Let's get into the numbers and figure out what this company is actually worth today.
So, this table shows a couple of different ways that analysts try to nail down a company's true or intrinsic value. The top two, DCF and MEV, are just fancy ways of looking at future cash flow and comparing Coke to its competitors. But you don't need to be a Wall Street pro to see the key takeaway here. Both methods point to a value somewhere between $64 and $68, and that is way below its current stock price of over $75.
And this right here, this just lays it all out, plain and simple. On the left, what you pay for the stock today. On the right, what the analysis suggests the company is actually worth. There's a pretty big gap there, isn't there?
So what this all means is that, based on the numbers, there's what investors call a negative margin of safety. Usually you want to buy a stock for less than it's worth, right? You want a discount. Well, in this case, investors are actually paying a premium. They're paying more than the calculated value, and that can make it tough to get good returns down the road.
But hey, maybe there's a good reason for that premium price. Let's dig a little deeper into the company's financial health and see what's going on under the hood. And right away, wow, the company's profitability is just off the charts. This 43% return on equity, that is a huge number. To put it simply, for every single dollar that shareholders have invested in this business, the management team is generating 43 cents in profit. That is just an incredibly efficient machine.
And the original analysis we're looking at really drives this point home, calling the profitability exceptional. This right here is a huge reason why people have loved this stock for so many years. It is a money-making powerhouse.
But it's not all perfect. The company does have a good bit of debt on its books, and maybe more importantly, if you look at its recent free cash flow, it's actually turned negative. All that means is that lately, more cash has been going out than coming in. The analysis calls it a mild concern, but it's for sure something you'd want to keep a close eye on.
So, with all that in mind, what does the future hold? Let's use a couple of common tools to think about the potential upsides and downsides for Coke moving forward. Okay, so what we're looking at here is a classic SWOT analysis. Strengths, weaknesses, opportunities, and threats. But with a little twist, each factor is weighted by importance. And when you add it all up, you get a final score of 7.15 out of 10. That's a really strong score, and you can see it's overwhelmingly driven by that number one strength, the brand.
Now this is really fascinating. This table shows just how much the company's value can change based on tiny shifts in its growth rate. In a bad bear scenario with slow growth, the value drops to $55. But in a great bull scenario, it jumps all the way to 80. And look at that base case, right in the middle. It lands exactly on our intrinsic value from before, $64.
All right, this all leads us to the most practical question of all. This is where the rubber meets the road. What is the right price to pay to hit our goal?
Let's circle all the way back to our original question. To get that 9% annual return we've been aiming for over the next 16 years, this analysis gives us a very, very clear answer. The buy price is $64 a share.
And here's what's really cool. That price stays pretty much the same. Whether you plan to hold this stock for 10 years or 16 years, the price you need to get in at to hit that 9% target is consistently right around that $64 mark.
So if there is one number you take away from this entire deep dive, this is it. $64. That's the magic number if you're targeting a 9% return.
So, we've gone through the business, the valuation, the financials, the price targets. What's the bottom line? What should an investor actually do?
Well, the recommendation is crystal clear. If you already own Coca-Cola, the verdict is hold. It's a fantastic business. You just wouldn't buy more at today's price. And if you're a new investor, the advice is to buy on weakness. Basically, be patient and wait for the market to give you a better price.
So, the single most important takeaway here is that with a company like Coca-Cola, it all comes down to valuation. The business itself is an absolute rock star, a great anchor for any portfolio. But the opportunity to make our target return, well, that only really shows up if you have the discipline to wait for a better entry price.
You know, this analysis is the perfect reminder that a great company isn't always a great investment at any price. It all comes down to patience. So, what iconic company should we put under the microscope next? Let me know what you want to see in the comments below.